Look, if you've been watching the stock market lately and just felt your head spinning, you are not alone. It can feel totally chaotic, unpredictable, and frankly, a little stressful. But what if I told you there's a way to see the method behind all that madness? Well, that's exactly what we're going to break down today. So, the big question is, right, how do we get from that feeling of confusion to a place of clarity? We're going to do it by breaking down the two fundamental forces that drive literally everything in the market: risk and return. Stick with me, because by the end of this, you're going to have a powerful new lens to see it all through. All right, so let's dive right in. First up, risk. It's a word we hear all the time, but what does it really mean when we're talking about an investment? As it turns out, not all risk is created equal. Let's break down the different flavors. First, you've got market risk. This is the big one. Think of it like a giant wave in the ocean that lifts or sinks all the boats together. It's driven by huge things like recessions or major political events that affect the entire economy. You know, when a company like Pollo Loco starts talking about macroeconomic uncertainty, yep, that's market risk in action. But here's where it gets interesting. A rising tide doesn't always lift every single boat. A company can still spring a leak even when the overall market is booming. That's what we call company-specific risk. It's all the drama happening inside one particular company, totally separate from what the wider economy is doing. So what does this look like in the real world? Well, think about it. A company drops a disastrous earnings report, or there's a huge product recall. Maybe the CEO suddenly quits. These are basically self-inflicted wounds or challenges unique to that business, and you can bet its stock price is gonna feel the pain, no matter how well the rest of the market is doing. Beyond those two big ones, you've also got something called liquidity risk. Imagine you want to sell your stock, but crickets, there's just nobody out there buying. You're stuck. That's liquidity risk in a nutshell. It's usually more of a problem for smaller, less-known companies, but it's a real risk to be aware of. And finally, we have the silent killer of wealth, inflation risk. This is the sneaky danger that your investment returns look good on paper, but in reality, your actual spending power is shrinking. I mean, a 5% return feels great until you realize inflation is at 6%, which means you've actually lost ground. Your money buys less than it did before. It's a crucial and often overlooked part of the whole risk equation. Okay, so we've talked about all this scary stuff, right? All the ways an investment can go down. But let's be real, nobody invests just to avoid losing. We're in it for the upside. So let's flip that coin. What are the forces that actually drive stock prices up? It really boils down to one thing: news, and how people feel about that news. Good news comes out, maybe a killer earnings report or a big shot investor says they love the company, and boom, everyone wants in. The price goes up. But the opposite is just as true. A scandal hits or performance is weak, and it becomes a race for the exits. Down goes the price. So we have risk on one side and the potential for return on the other. But they aren't separate, they're connected. And honestly, this connection, it's the single most important rule in all of investing. If you get this one thing, you basically get everything. And here it is, the one rule to rule them all. Higher potential returns always come with higher levels of risk. And on the flip side, lower risk investments will almost always offer lower potential returns. There is just no such thing as a free lunch in investing. Risk and reward are two sides of the exact same coin, forever linked together. Let's make this really concrete. On one hand, you've got a big, stable, blue-chip company. Think of it as a steady cruise ship. It's low risk, but you're not going to break any speed records. This is all about preserving your capital. Then you've got a young, scrappy growth company. This is the speedboat. It's a wild ride, super high risk, super volatile, but man, the potential for massive returns is there. The real question is, which ride are you willing to get on? And this is where it gets really personal. It all comes down to your risk tolerance. I mean, are you the kind of person who can watch your portfolio drop 20% and just sleep soundly at night knowing it'll probably bounce back? Or does that thought alone give you a full-blown panic attack? Your answer to that question is one of the most important things you can know about yourself as an investor. Okay, theory time is over. Let's get practical. How does this whole risk-return framework actually change the way different people invest their money in the real world? Well, the mindset changes everything. For most of us regular folks, investing is a balancing act. We diversify, we play the long game, we want steady growth. But then you look at someone like a venture capitalist. They are playing a completely different sport. They are swinging for the fences every single time. They know most of their bets are going to fail, but they're hunting for that one massive home run that pays for all the losses and then some. See? Same rulebook, radically different strategies. And that is the whole point. This isn't about having a crystal ball to predict the future. It's about having a framework, a game plan. It's about shifting from just guessing to actually making strategic decisions that fit you, your goals, and your own comfort level with that financial roller coaster. At the end of the day, this isn't just some abstract concept from a textbook. It is, as one source put it, the absolute bedrock of making informed investment decisions. Understanding this relationship is what turns random gambling into strategic investing. It's the key to building a real plan to reach your financial goals. So there you have it, the fundamental rules of the investing game. You can't have the potential for a big reward without taking on some risk. They are forever linked. Now you know the rules. The only question left is, how will you play?